The S&P 500 just made history, and most people have no idea what it means for them. The S&P 500 just crossed a milestone that has never happened before in the entire history of investing. And most people scroll right past the headline without realizing what it actually means for their own money. The Vanguard S&P 500 ETF became the first fund in history to hit $1 trillion in assets. The Dow Jones crossed 52,000 points for the first time ever. And right now, while all of this is happening, most Americans are still sitting on the sidelines, not invested in a single dollar of it. That gap between what the market is doing and what most people are actually doing with their money is exactly what this video is about. Let's start with what this moment actually means and why it matters more than any headline number. When a fund hits $1 trillion in assets, it's not just a big number for a press release. It's a signal about where the money in this country is actually going. Millions of ordinary people, not Wall Street professionals, not hedge fund managers, not people with connections or special access, are quietly building wealth through the same basic tool that's been available to anyone with a brokerage account for decades. And the data on who those people actually are will probably surprise you. 8.8% of American adults are millionaires right now, about 24.5 million people. But here's the part that changes how you should think about this. 80% of them build that wealth themselves. They didn't inherit it. No family money, no lucky break, no tech startup. The typical American millionaire is 62 years old and hit $1 million around age 49 through career income and consistent investing. Not by picking the right stock at the right time, not by getting in early on something secret, just by investing consistently for long enough. If that's surprising to you, here's the first thing I want you to do before we go any further. Think about what you have invested right now, not what you plan to invest, not what you've been meaning to get around to, what you actually have working for you in the market today. If the honest answer is nothing or almost nothing, then this video is going to matter a lot more to you than any headline about the S&P 500 hitting a record. If you're liking this so far, hit subscribe right now, because every week I break down exactly what's happening in the market and what it actually means for your money. Now let's talk about the math, because the math is the part that most financial news skips entirely, and it's the part that either changes everything for you or stays theoretical forever. The S&P 500 has averaged around 10% annual returns over the last 7 decades. That's not a guarantee of the future, nothing is, but it's the most consistent long-term track record of any major investment class that exists. And here's what that 10% actually does to money over time, because this is the number most people never actually sit with long enough to understand it. If you invest $500 a month starting today at that historical average return, you're looking at reaching $1 million in roughly 31 years. That sounds like a long time until you do the math on what you're actually putting in. $500 a month for 31 years is a total contribution of around $186,000 out of your own pocket. The other $814,000, the majority of that million, came from the market doing what it does when you leave it alone long enough. You contributed less than a fifth of the final number. Compounding did the rest. Now here's where it gets even more interesting and more urgent depending on where you are in life right now. The same target of $1 million requires very different monthly contributions depending on when you start. If you're 30 years old, you need roughly $500 a month to get there. If you're 40, that number climbs to around $1,300 a month. If you're 50, you're looking at over $3,500 a month just to hit the same goal. Same destination, dramatically different price depending on how much time you give the math to work. This is why every year you wait is not just 1 year of no progress. It's 1 year of compounding that never happens, and you can never go back and add that year later. And this brings us to the question that actually matters, which isn't whether the S&P 500 hitting a record is good news or bad news, because most people ask that backwards. They see a market at all-time highs and think it must be too late to get in, that they missed the window, that buying now means buying at the peak. But here's what the data actually shows about that fear. The S&P 500 has hit all-time highs over 1,000 times in its history. Every single one of those days felt like a peak to someone who was watching, and in almost every case the market continued higher over the following decade. Waiting for a pullback to invest is a strategy that has cost the average person far more money than the pullback itself ever would have saved them. The most common occupations among American millionaires are not what you'd expect either. It's not bankers, it's not tech founders, it's not people in finance. It's engineers, teachers, accountants, and small business owners. 5% of millionaires in this country are teachers, more than doctors. How? Higher savings rates, consistent investing, and discipline over time. The boring path is the one that actually works. And the market hitting record highs is not a reason to stay out. It's a reminder that the boring path has been working this entire time while most people were waiting for a better moment to start. Here's the practical piece, because understanding all of this doesn't do anything for you if you don't connect it to an action today. If you have a 401k through your employer and you're not contributing at least enough to get the full employer match, that's the first thing to fix. Because the match is an instant guaranteed return on your money before the market does anything. If you don't have a 401k or you've already maxed the match, opening a Roth IRA and putting it into a simple S&P 500 index fund is the most straightforward version of exactly what built the wealth of those 24 million millionaires. Not a complex strategy, not active trading, not timing the market. One index fund, automated monthly contributions, left alone for decades. The S&P 500 hitting 1 trillion in assets and the Dow hitting 52,000 aren't just headlines for financial news channels. They're the scoreboard of a game that's been running for decades, and 80% of the people winning it started with nothing and just chose to stay in long enough for the math to work. The question isn't whether the market is at a good level to get in. The question is, how many more years are you going to spend not being in it at all? If that hit home, drop a comment below with where you are right now. Just getting started, already investing, or still trying to figure out how to begin. I read every single one, and it genuinely helps me know what to cover next. And if you're not subscribed yet, do it now. New videos like this every single week.